Simon, that's a really important question, but it's exactly the wrong question for investors to ask. Because what it does, it encourages us to focus on the short term. And we know that investment is all about the long term. And this is a really dangerous time for investors because we see prices moving very rapidly. We saw them move in one direction, and then they could move back in the other. And so it's really important to take stock of what's happening, try and dig below the surface news, but don't get too caught up in the day-to-day movements. Really focus on what the value is telling us about the longer-term horizon.
In terms of the rate outlook, it's been quite staggering seeing a couple of weeks ago what was an expectation of one or two cuts later this year suddenly reverse with some analysts now predicting Bank of England to raise rates in the next couple of months. Do you give any credence to those projections, and how can they transform quite so quickly?
Well, it's a great reminder that economic forecasters exist to make fortune tellers look good. That we are constantly reminded that economic forecasts change very rapidly and have a terrible track record of being correct, and so are almost useless from an investment perspective. And so the bigger question, I guess, is for individual savers and investors, and they're going to be worried about what's happening to their portfolios and also what's happening to their savings and potential interest rates as well. So yes, the future is not looking as rosy as it was a few weeks ago, but remember, prices haven't moved that much. Interest rates haven't moved at all yet, and so it's really important not to get too het up with what the future may hold. This is potentially a very short-term situation. We saw that in April last year, where we had another big policy announcement from the president of the US, and that really blew over quite quickly. The same thing could happen this time.